A fragile calm has returned to global bond and stock markets after weaker than expected US jobs growth halted a rise in wholesale interest rates to 16-year highs. Oil prices are down 5% this morning. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, we have part 2 of our chat with ANZ's Chief Economist for Greater China, Raymond Yeung, about the 40th anniversary of the Hong Kong dollar's peg to the US dollar and where it goes next.
In the past, it is basically very conventional, financial architecture, but in the future, it is leaning towards more of the digital era.
But first, in 5 and 5 with ANZ. Number 1, US private sector jobs, as measured by the payrolls firm ADP, rose by just 89,000 in September. That was barely half what markets were expecting, and only half the growth seen in August. That turned around the ongoing sell-offs in bond and stock markets globally. Before the ADP numbers came out, the US 10-year Treasury yield hit a new 16-year high of 4.88%. By afternoon trade in New York, the 10-year was back down at 4.74%. That meant the S&P 500 and the NASDAQ were back up again, up 0.3% and 0.7% respectively. The Aussie and Kiwi dollars, they were also off their overnight lows by this morning at 63.2 and 59.1 US cents respectively. Oil prices, though, the big mover, down almost 5% this morning. Brent down to $87 a barrel and West Texas down at $85 a barrel. It really was all about the ADP numbers overnight. Here's ANZ's head of G3 Economics, Brian Martin, talking from London this morning.
The market took the data as evidence that the economy is slowing and that the FOMC will not need to raise interest rates at the November 1 meeting, which is coming up in a few weeks' time. So it rallied. We saw some of the selling pressure in fixed income markets ease and equity stabilised in what I would call a very fragile calm.
Number 2. Earlier overnight, the US 30-year Treasury bond yield, and remember that's the one underneath US mortgage rates, it rose over 5%, also a 16-year high. This week's sell-off in global bond markets has been a thing to behold. Here's Brian to explain why the moves have been so large.
The FOMC sent a very clear signal that it is not going to be easing real interest rates anytime soon. The ECB reacted to a very small upward tweak in its headline inflation forecast and raised interest rates 25 basis points. And I think the signalling that we're getting from central banks is that they are really determined to get inflation under control. And in the economic environment we're in at the moment, interest rates need to be higher. And I think the bond market is taking that on board now. Expectations of a quick pivot from central banks are no longer driving bond yields. Number
3, the Reserve Bank of New Zealand held its official cash rate at 5.5% yesterday, as expected. Here's ANZ senior strategist David Croy to explain.
So there was no obvious hint that the cash rate would need to rise in what they said, but they did say that the interest rates would need to remain at restrictive levels for a more sustained period of time. So a little bit of an upgrade there in terms of the characterisation there. So I would say that that's consistent with high for longer rather than higher for longer. And again, that's very consistent with what we've heard from other central banks this year. So it's about pushing back on market expectations of policy being eased sometime in the future rather than giving a strong signal that policy needs to be tightened again, and particularly not giving away any signal around the timing of that.
Number 4, there was some positive news yesterday from South Korea, where industrial production had the biggest gain in over 3 years, on the back of a surge in chips production. Here's ANZ Economist for Asia, Crystal Tan.
The August numbers were quite encouraging. There was a seasonally adjusted 5.5% month-on-month increase, so that broke the downtrend that we saw in the past couple of months. And it's notable that it was a surge in semiconductor production that was the key driver, thanks to demand for high-performance memory chips.
Number 5. But Crystal says the Asian recovery is far from certain, though.
Well, it looks like South Korea's manufacturing sector has started to find a floor. But at the same time, I think headwinds to a robust recovery do remain, including the still elevated inventory to shipment ratio. And if you look at some of the other economic data that have been released also, like retail sales that softened a bit, facility investment that had remained sluggish. So overall, it's still challenging growth backdrop.
Now it's time for our deep dive interview and part 2 of our discussion with Raymond Yeung, marking the 40th anniversary of the Hong Kong dollar's peg to the US dollar. He saw its future as assured. I asked, though, if there would be any chance it could be pegged instead to the renminbi, now that Hong Kong is much more a part of China's state system.
Hong Kong remains, from the Beijing point of view, a very important offshore financial center. So there's no point for them to peg with the renminbi. And in fact, if many of the argument for Hong Kong dollar be pegged to renminbi instead of the US dollar is primarily because of the sovereignty or sovereign consideration, and why the China needs to have its own within its own jurisdiction to peg with a foreign currency. But if you consider the role of Hong Kong as an offshore financial center, it actually makes more sense for it to peg with a global-based currency. And if they really want to push for renminbi internationalization, then there is already a CNH market that is very liquid, in the offshore markets, particularly in Hong Kong banking sector. This is the first argument I would see. And secondly, because this peg is already a very solid establishment, and I noticed that last year that even the People's Bank of China and the HKMA, the two main regulators, they signed a currency swap agreement, to fix this both renminbi and the Hong Kong dollar at a particular rate. It's not a 1-1 equivalent. It's nothing to do with Hong Kong dollar had to peg with the Chinese currency, but this is actually an acknowledgement that the Beijing actually really want the peg to stay, so that they signed this agreement and the swap line on a permanent basis. And that reflects that there is actually I would think that a political wish to maintain this system.
What's the future for the Hong Kong dollar in terms of how it develops and how it deals with things like digital currencies or blockchain?
You will have to acknowledge that the role of China, in the global economy has changed dramatically in the past few years. But one thing which is very clear is that Hong Kong continues to play a very important role as an offshore financial center for China in a new era. Now, under the new regime, we would think that as China is trying to progress itself to be a very tech-oriented economy, and also want to be more self-dependent in terms of managing themselves, then there might be some consideration for Hong Kong dollar to upgrade the peg system. I'm thinking about, is that any way that Hong Kong is now considering to upgrade the payment system so that it will be more compatible to the digital age, as China also enter a more tech-oriented economic regime. And secondly, how Hong Kong can make use of the development of other technology in payments, namely blockchains. And also, the Hong Kong government started to develop the virtual asset market. How would Hong Kong dollar continue to play a role as a financial currency? In the past, it is basically very conventional, financial architecture. But in the future, it is leaning towards more the digital era. And or I'm not using the term crypto, but I'm using more the term of a new form of virtual financial era. Now, from this perspective, then I believe that this Hong Kong dollar peg also need to evolve, so that the future architecture of this monetary system will be more compatible to the future development of the international financial system.
Raymond Yeung there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, October the 5th. Catch you tomorrow with a preview of Friday night's all-important non-farm payrolls data from the US. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.